5, 4, 3, 2. We're here today on another episode of the Mobile Mailbox Money Podcast. Here today with Dan Deppen from Call the Underwriter. Dan, if you could just introduce yourself for the viewers that don't know you.
Yeah, no problem. Well, first off, thanks for having me on. But yeah, my name is Dan Deppen and acquired Call the Underwriter last year. And so what we do is underwriting for seller finance loans. So we help lenders figure out whether they've got good borrowers or not, and then also help them with some of the compliance aspects, complying with Dodd-Frank and RESPA and other things when they're doing owner-occupied loans. And then I've also been a buyer of notes for about the last 8 years or so, both performing and non-performing. And so, lots of various experience in the note world.
Love to hear it. It sounds like it's been a good ride with Call the Underwriter from your acquisition. So glad to hear you're prospering. I hear your name coming up frequently. People talking about Call the Underwriter and the fantastic service that you guys provide. Underwriting's definitely a necessity when dealing in originating notes. It's really important for people to understand to have that tool at your availability. Met Dan at a few different conferences, note investment conferences. Dan, how are you attending any conferences this year, and where maybe can people meet you in person? What's your schedule like?
Yeah, so at the end of February, I'll be in Scottsdale for the Noteworthy conference. And then it's the beginning of May, I'll be in Nashville for the Diversified Mortgage Expo that Nathan Turner puts on. And then in November, I'll be in Dallas for Note Expo with Eddie Speed and company.
Good to hear. Active out in the industry. I saw you bring on multiple people on your podcast, probably that you know through mutual relationships or met out at those conferences. I think we've seen each other at each one of those conferences. Happy to do business at the end of the day with people you know, like, and trust. That's important. That's a foundation and why people attend these conferences and meet individuals. And I'm happy to have met you, Dan. Definitely a warm room. We know a lot of the same people. It's relatively a small industry in notes. How did you kind of get started in notes? What made you pivot maybe into the alternative strategy of notes and providing underwriting kind of alternative nature? What made you jump into that?
Yeah, so back around the 2016-ish timeframe, I just wanted to diversify some of my investments into real estate. So I started my career as an engineer in the aerospace industry, and then got an MBA, worked in the tech industry, and had always been big into saving and investing. Like, I started buying stocks when I was 18 years old. And after having invested in stocks throughout the dot-com boom and bust, around the turn of the century, and then you had the financial crisis hit and stocks went down 30%. I didn't want to have all of my eggs in one basket. And so I wanted to move money into real estate. And, even back then in the Denver area where I live, I originally looked at doing rentals. And even back then, like, cap rates on rentals were just real tough. And I started poking around looking for alternatives. And that's when I came across notes. And I think the reason I was attracted to that is, one, it's I like lucrative niches that have maybe like a little bit more nuance or complication that kind of keep people out, right? So if you get into notes and you're looking to buy existing notes or originate them, there tends to be a lot less competition than other more traditional investment types. And growing up, my dad and my grandfather worked in the loan business. Not this specifically. What they did was different, but I kind of grew up around that. And then when I was in business school, one of my favorite courses was in fixed income, which is basically bond analysis. Not exactly the same as notes, but kind of similar. I liked a lot of the math, so it was just an area that drew me in. Because if you look at the size of the mortgage market, it's gigantic. And there are a relatively small number of individuals that play in this space. To your point earlier, yeah, it is kind of a small world.
Yeah, no, the riches are in the niches at the end of the day. To kind of niche down to a non so much competitive environment you end up being at the forefront of everything that's going on, and a lot of the players, aren't all that big. So it's good to have community base around that and things of that nature. Glad to hear that you've been, pivoting into the, more passive nature. Rentals, have their challenges at any given time. What were some of the major, rental problems that you were having conventional of? I'm sure, note investors hear that kind of stuff all the time, but what were some of the headaches that you were having pivoting into notes, at that?
Yeah, so for me, I'm a little bit unique in that, I originally started looking at rentals, but I couldn't get the math work out, and I never actually have owned one. So I went straight. My first foray into real estate investing was straight into notes. Usually people are doing something else and then they become aware of notes and they kind of gravitate to it.
Sure.
Yeah, my path was a little bit more rare. I just skipped over the traditional stuff and went to the other things. And the thing I would tell people is like, part of the reason it's small, part of what keeps people out of it is it's perceived as being, more complicated and difficult than other things. And it does have its nuances, right? Like you do want to get some training, you do, have to know what you're doing. But I tell people that at the end of the day, like it's not rocket science. Like it's not that hard. So like I had a really amazing physics teacher in high school, and what he told us when we were doing physics, which is like, it's a hard topic for high school. He's like, approach this as if it's easy. He's like, if you approach it as if it's easy, just mentally, it's easier to get things to click. Like if you approach something new and assume like, oh my God, this is going to be super hard. Well, then it kind of becomes a self-fulfilling prophecy. But I mean, really, if you look at the way that, loans work, there's a principal balance, there's a payment amount, there's an interest rate, there's a term, and then there's some stuff on, title, making sure that that's clear, and documentation, and making sure it's enforceable. But, once you know it, and the other thing that kind of attracted me to notes as well is once you have your little system in place and you know what you're doing, it really lends itself to rinse and repeat. I mean, every note's its own special butterfly, but it really lends itself to putting together systems and processes and where you can scale things up and do more.
No, absolutely. Having those checkbox items at the end of the day of a transaction is important. And using an underwriter, that's extremely important to add to the value of that note. Maybe you could touch lightly on that, how your service provides individuals, that availability to add further stability to their note, providing it to be traded on the secondary market. That's a tool at someone's availability that may be watching here today. The services that Call the Underwriter has, maybe you could just touch lightly on, the processes that you guys go through and why someone may reach out to you for those services.
Sure. So there are a couple of reasons people would do that, right? And so the common scenario is someone selling a property, they're doing owner finance, they're creating a note. It could be, an existing property they have. Sometimes people have rental properties and they want to basically convert them to notes to keep cash flow without the property management, or people will do, fix and flip and then exit with a note. And then people go into these with different intentions, right? So if your intention is to hold the note, it really makes sense to underwrite your borrower to make sure you understand what you have, right? So if you want to hold this for income, you want to make sure you have a good borrower that's going to make payments on time. Because I'll tell you, having bought a lot of existing notes and done a lot of performing notes, even though you might have had a good down payment and you've got the right to foreclose, and, even if it's a relatively fast foreclosure state, say a non-judicial state, it's not always a picnic, right? Because I've had borrowers fight me in court and drag things out. I've had borrowers, in fact, one relatively recently filed bankruptcy the day before the sheriff auction to drag things out. Or, you get the property back and you find out that they just live like pigs and this property is really messed up. So, while the value of your collateral and the right to foreclose is a really important part of your equation, like, you don't want to rely on that. Like if your goal is just to collect income, you want to collect income. So it makes sense to vet the borrower, to understand what their debt to income is, if they have the ability to repay, what their credit score is, what's their credit history? Do they pay their debts? Do they have a lot of bad debts out there? What are you getting into? So that's number one. But then the other thing too is a lot of times people either create notes with the intention of reselling them, or they may change their mind and want to resell them later. And when you do that, you got to think about things from the perspective of your potential note buyer. And what your note buyer is going to want to love to see is that complete underwriting package, right? So imagine like I'm a note buyer and and two different people send me two notes. And one of them has the complete package, all the income documentation, the DTI. I know it's done by Dodd-Frank standards, the whole 9 yards. And then the other one, they did nothing. It's just here's the loan, right? I'm not going to value those two things the same. So when you underwrite the loan correctly, it does increase, it not only increases the value of the loan when you go to sell it, but it opens up the aperture on the buyers, right? Because there are a lot of buyers who will not make an offer on a loan unless it's underwritten correctly. So the price you can get, your addressable market, like how fast you can sell that loan, changes dramatically when you get it underwritten. And then the other aspect to touch on is if the property is going to be owner occupied, there's a whole host of consumer laws that you have to comply with, right? So you have to send a loan estimate 7 days before you close, the closing disclosure 3 days. You got to validate that the borrower has the ability to repay per Dodd-Frank, and a bunch of other things. And that's what we help clients with as well. And really the thing you're guarding against there, for the most part, I mean, granted, there's laws, you have to follow those things, right?
Absolutely.
And if you don't, on a one-off, nothing's necessarily going to happen. But the scenario that investors need to watch out for is the one where you create a loan, the borrower defaults, typically, without any major life changes, so they didn't lose their job or have a big medical bill or get divorced. You start foreclosure, and then the borrower shows up in court and says, hey, I didn't know what I was doing here. I never had the ability to pay this. This was a predatory lender. And then the judge turns and asks you and says, well, did you follow all the rules? Did you send the disclosures? Did you validate the ability to repay? And if you don't have any of that, that could be a dark scenario, right?
Absolutely.
That could be bad. And really, from a compliance perspective, I think, that's really the scenario that you're also protecting against. But, that's also somewhat of a corner case, right? Like if you're doing the right things, you shouldn't run into that. But having that package, should you go to resell the loan, is really handy. The other thing I have a lot of clients doing, and I'm not an expert in this area by any means, I haven't done one, but a lot of our clients are creating loans as part of subject to deals. I've heard they've got this underlying loan, and if God forbid the underlying loan gets called due on sale, they may need to sell that loan to pay the other one back. And so in that case, you really want to make sure you've got a really high quality loan if that's your game plan, to deal with a due on sale. You don't want your game plan can't be, well, that's never happened before, so hopefully it won't. And if it does, I'm dead. Like that's not a good plan. So that's not.
That was a lot right there. You provide further validity to the note. You help current long-term rental strategies convert them to seller finance transactions, help them navigate that situation, sounds like. Also provide further security and safety to the investor creating the note for potential litigation issues if someone were to arise. Those are all really important to navigate that process. And you were saying how someone from the outside perspective, looking into note investments may be overwhelmed by these specific aspects, but it sounds like you got a pretty cut and dry process to be able to help someone navigate that process and really tell them, hey, this works or not.
Yeah, and Call the Underwriter was originally started back in, I think, 2017 timeframe. So we've got some pretty good systems and processes for turning the crank on those. So I would say doing underwriting a deal and following all the compliance rules, it's kind of like note buying in general. When you're doing it for the first time, it could be overwhelming and daunting. If you've done hundreds of them and you got a system in place, it becomes fairly routine and straightforward. So the other thing we have to leverage that I'm in the process now, since I bought the company, is we've got a really large database of a few thousand seller finance loans. And so I'm in the process of working with some people to go back and find out how many of those ended up in foreclosure eventually. And from there, I can build a regression model to really help clients and tease out, when they're constructing their loan terms and putting together the deal, understand the relative, risk level of what they have and the probability of default, and, what they could do to improve it.
Some more analysis-based movements forward. That's, awesome.
Yeah, absolutely. Yeah, because I don't know if anyone has access to the same level of seller finance data as I do
They may not.
right now. I mean, you can get, there's a gentleman, Scott Arpin, who, does a lot of combing of county records. Like, you can pull raw data on them. But I don't know if anybody has all the raw data on this many loans with a complete underwriting file to go with it as well. So I plan on, as we get deeper into this year, definitely leveraging that to help clients.
Yeah, I mean, even putting that data on your website could get you more website traffic of people looking for those kinds of numbers. That's awesome to hear.
Yeah.
How did you learn about navigating these processes in notes? So did you take an education? Did you learn?
Oh yeah.
Around?
Yeah. So last year, okay. So in my note buying, I mentioned I've done a lot of non-performing loans, and so some of those go
The
through
hard
way, or
Yeah.
I do cash for keys, and so I've sold a number of REOs over the year, and when I've done that, when I have the opportunity, if I can find the right buyer, I'll try to do seller finance. So I had actually been a client of the Underwriter going back about 6 years, and I had seen an increase in the level of seller finance activity in general for a number of reasons. I mean, part of it is banks have retrenched to a degree. It's very fascinating how prior to the financial crisis, you had these absurdly non-existent bank lending standards. And then, the government put Dodd-Frank in place that put a floor and said, well, your standards need to be at least this. But since then, banks have really tightened way right here. So there's this gap between what is a good practice and where banks will play. And so I've seen all this increase in seller finance activity. So I had actually spent several months last year working on setting up a competitor to call the Underwriter, until I found out that Max was interested in selling. And so, in the midst of that was when I went down the whole rabbit hole, figuring out underwriting. And then there is a 20-hour RMLO course that's required. And then this multi-hour test you got to go in and take, which I had taken and passed, and, and did all of that good stuff. And then, after the acquisition, spent a lot of time with Max and Michelle on how they do it, right? Because there's the certification and the required training, and then there's the actual day-to-day. And then in the last several months, I've been working on improving those processes and streamlining them and updating them. And then I also signed up for this other course that I've been working on, where I'll be getting this Master Underwriter certificate a little bit later this year. So always focused on improving the process that we have.
The day you stop improving is the day you start to retire, at the end of the day.
That's a good point. Like I've worked in other industries, like when I worked in aerospace, and I worked for Amazon, for AWS on the supply chain software. And I've worked with these dudes before who were like, yeah, I've got, 25 years of experience in this area, or 30 years of experience in this area. But if you're not learning new things and changing things, and if you're not adjusting, it doesn't really matter how many years of experience you have, right? And that's why, in real estate, the best people are always adjusting and looking at, new things. I've had some conversations with a guy like Eddie Speed lately, right? And he's been at this for 45 years. And what's cool about what he does is he's always trying new stuff and learning new stuff. So yeah, he's got decades of experience and he's been learning the whole time. So that, yeah, so it's your point, like that's way more powerful than somebody who's just been like doing the same thing for a long time. Because in real estate, that kills you, because like from what I've observed, even just in the last 8 years or so buying notes, market conditions fluctuate a lot. And so like there were certain, I'll call them recipes, like for buying non-performing land contracts that worked really well in like 2018, or, you know, back in the day, this wasn't ever really my thing, but there are people at this model of buying these large packages of defaulted second position notes for pennies. And, you know, if you try to do that now, it doesn't work. One, the supply is probably not available. The pricing is different. The market's different. So there's always opportunities in every market, but you have to understand the high level principles of what you're doing and then just always be adjusting. So if you find a recipe that works, eventually it's not going to work.
What do you see working right now? Given the various notes that you see, you mentioned land notes, you see multifamily, you know, single family. What's your opinion on that?
Yeah, I mean, so there's a lot of ways I can slice that. So like really 30,000 foot view, I would say in general, most of the opportunities are in performing notes, right? So there's not like last year I bought a couple non-performers. You got to be a little more opportunistic. I think right now it'd be hard to build a business out of non-performers because there aren't as many of them out there. And the pricing spread between performers and non-performers are such that you may as well just buy the performing note. And those are pretty awesome because whether it's newly originated or been around for a while, I mean, it's very easy to get double-digit returns on performing notes with good borrowers with a lot of equity. So to me, I love those because, you know, comparing them to the range of investments out there, you're basically getting a little bit higher than a stock market return, but without all the volatility in it, right? So you strip out the risk of, especially if you're like nearing retirement or in retirement. You know, if you get some big event, like I've lived through a couple with the dot-com bust or the financial crisis where the stock market dives 30-35%, you know, COVID, it did a weird dip, but then it came back. You know, you can kind of insulate yourself from those. So I think those are really good. There are a lot of existing loans on single family properties where the borrowers paid them down over 10 years and they have boatloads of equity because the price has gone up. Like I've got some loans that are, you know, a lot of mine are small, but I've got a bunch with like $30,000-$40,000 loan balances where the property's worth like 150 and the borrower's paying. So, you know, it's almost, if it's a land contract where you get the property, it's almost like a bonus if they stop paying. So I like those a lot. And then the other thing that's increasingly popular, you know, it's not just you guys, but others here, but mobile homes. When people want higher yield, you can start to get more of that like 14, 15, 16% range. I know like a lot of investors I've talked to, they're a little bit allergic to that because they're not that familiar with them. But I think that's back to my earlier point. Like if you got a good recipe for single family, that's fine. But if you understand risk versus reward and the broad concepts, you know, there's opportunities there. Like I bought my first mobile note, home note last year for the first time in my IRA, and I've been liking that.
What market was that in?
Oh, I'm thinking Michigan. I forget offhand. I own about 60 notes altogether, so they kind of
Blend together.
I have to like look everything up. Yeah, I don't know. Right? Yeah, I think it was probably in the Southeast somewhere. I'll have to get that to you later. But then, you know, you're also seeing a lot of popularity of land, like people creating a lot of land notes. Like I know a lot of folks who are buying areas of land, like particularly in Texas, and then subdividing them, and then sometimes, you know, adding utilities and doing other things, and then dividing it into lots, and then selling those on owner finance. I haven't done one of those firsthand myself. I haven't bought any land notes yet. I mean, I've definitely looked at them. I think they make sense. The only reason I haven't pulled the trigger on any of the ones I've looked at is these are areas that I'm not personally familiar with. And so I just have a hard time valuing it. Other types of collateral are just a little bit easier to figure out what the collateral value is. And there's only time in the day for so many things, right? So you want to, it helps to kind of specialize somewhere and focus. If you try to do too many things, then you get spread too thin.
Absolutely, completely agree. Well said on all of that. You currently run a great podcast. I've watched multiple of your episodes. I'm a fan in the background, so great to see that you're cultivating a presence on social media through YouTube and other platforms. It sounds like maybe you could just touch lightly on your podcast.
Yeah, so I started with the Note Investor podcast several years ago. I think I've got the 117th episode just came out, which was with you and your father, just actually today that we're recording this. I don't know when this is airing. And then I've had the YouTube channel for a while, so I'll put the video versions of the podcast on YouTube, and then I have other videos on there as well. I'm working on a bunch of new content on seller finance that I need to add in there, but that's taken a while. And then more recently, I've been active on LinkedIn. That was something I didn't previously do with real estate because I was always working W-2 jobs and doing real estate as kind of a side thing. So before it was my full-time thing, I kind of didn't want to spook people I worked for on LinkedIn. And my fiance is like a big LinkedIn power user. So she's been helping me out with that. So now starting to do more stuff on LinkedIn as well, thanks to her.
Got the power team going.
Yeah, for sure.
Good to hear. Well, yeah, the Note Investor podcast, is that just on YouTube and LinkedIn?
Well, yeah, I mean, we post the links on LinkedIn. So if you search any of the podcast platforms, so, Apple or Spotify, any of those, the service that I use to host it puts it out to wherever you find podcasts. So you can find it there, or search Fusion Notes on YouTube, and you can find me on there as well.
Yeah, glad to hear. Appreciate having you here today, Dan. If individuals were looking for more information, how to call you, contact you, send you a letter, how would they do that?
Yeah, so if you just go to calltheunderwriter.com, you can find all my stuff there. Or if you just want to drop me an email directly, you can go to dan@calltheunderwriter.com.
Or meet Dan in person at Noteworthy here in Scottsdale, Arizona at February 28th. We'll have a booth as well. I'll try and get you on camera out at the event, see if we can't get a take of what that looks like. But that's Dan Deppen here today. Dan, appreciate having you here today. My pleasure.
No, thanks for having me on. I appreciate it.
Absolutely. Bam, bam, bam.